Well, thanks. It's a great pleasure to be back here. I really enjoy this group tremendously. All of you are so keyed in to economics and the effect they have on markets and stuff like that, and that's my field. And so I really feed off the expressions that I see on your face. And today we're going to talk about what else, something that's really at the top of most people's minds today, and that's the election and what's going to happen. And I have my own views about this election and what's involved with it, but I just have this feeling, you know, we've been through elections before, and I'd like to see how you feel about it too. So I'd like to have a show of hands. Raise your hand if you believe this is a normal election. Okay, another show of hands. Raise your hand if you believe this is an abnormal election with abnormal candidates. Okay. How many people just prefer not to raise your hand, regardless of what the question just happens to be? Well, there are an awful lot of unknowns at this point in time. And within, 8 weeks, we should have a lot of things cleared up. I mean, at this point, we don't know whether we're going to have Hillary Clinton as the next president. We don't know whether we're going to have Donald Trump as the next president. And if the Russians are as good at hacking our election as some people have claimed, we might have another person. You know, there could be a dark horse in this election. At this point, you know, let's face it, there are an awful lot of unknowns. One of the things about this election that I think is more disturbing than other elections is that there's been an awful lot of negative stuff thrown at each candidate. And frankly, I think that this really isn't terribly constructive. And I believe that we should really strive as best we can to say nice things about the candidates. So when people ask me, what do you like about Donald Trump? I don't hesitate them. I said, what I like about Donald Trump is the man's humility. I mean, his sensitivity to people. I mean, let's face it, these are important characteristics in a person. And then when they ask me, what do you like about Hillary Clinton? You know, and I have to be honest, these pantsuits are to die for. Let's face it.
Wow.
I knew it. You gotta like that about her. But anyway, those are the nice things. On a slightly more serious note, it can be very difficult to talk about candidates and their policies at the time of an election because many of us get emotionally attached to one candidate. We either love them or we hate another candidate or something like that. And it's unfortunate because I'll be saying some things about the candidates and their economic policies that you may like, you may not like. But what I want to do is try and clear the air right at the beginning and say that we should really recognize and respect everyone's ability and recognize their right to choose whatever candidate they want for whatever reason they want. And there are reasons besides economics that you might choose a candidate. We all have the right to do that. I know I personally would have a reason, even if one candidate had all the right economic policies, doesn't necessarily mean I'm going to vote for them because there may be, and there is, a more important reason that I would look for to vote for a person or not. And I think we all have these sorts of biases. What I want to tell you is that in my presentation today, I'm going to be talking strictly about the economic policies of the candidates and the impact that they will have on the economy. I think this is critically important, particularly for this group. We are all in the financial industry, all of us, and we have a fiduciary responsibility to learn as much as we possibly can about economic forces, how those economic forces affect financial assets, how they'll affect the financial well-being of our clients. I mean, this is the business that we're in. This is what we're getting paid for. Now, you may disagree with some of my economic analysis, and hey, That's okay. We're going to have a question and answer period afterward. You can bring stuff up like that in the question and answer period. But I really believe that you should be open to whatever information you can get about economic forces and how they will affect the economy and financial markets. And you have to do it for the benefit of your clients. Now, my main objective this morning is to talk about the economy. What are the main economic forces? How are they impacting the financial markets? And, of course, what are the candidates' positions and how will they affect these economic forces? And in turn, how will those affect the financial assets? In order to make the presentation, the way I've organized it, I mainly have three topics that I'm going to talk about. The first topic is going to be the general economy and what makes, specifically, what are the forces that make an economy extremely successful, prosperous, and what are the forces that can cause an economy to perform very badly. The second topic I'm going to talk about is money and the Federal Reserve and the impact that that has on the economy and financial markets. Now, after I finish with those two topics, I'm going to take the framework that I've built in each of these areas and put it into analyzing the impact it's going to have on the policies as the candidates have stated them, and the impact that's likely to have on both the economy and financial markets. So anyway, I just wanted to let you know that's where we're going. Well, let's start first of all with what I think is the most important question in economics. The question is, why do some economies do so well? Why do some countries do so well? Why do some do so poorly? Why is it that at times our country performs so well and at other times we seem to perform so badly with respect to our economy? To me, this is the most important question in economics. Matter of fact, it's the reason I really got into economics. You can get into economics for a lot of reasons. I think a lot of people get into economics because they think you can make a lot of money with this sort of knowledge, and you can make a lot of money with this sort of knowledge, but that's not what drove me to have an interest in economics. I was interested in economics because I felt that with certain knowledge, you could really help people if you understood economics. And I try and think, why did I ever think that way? The more I thought about it, I traced it back to some conversations I used to have with my grandmother when I was a real young kid. She would often tell us what it was like when she was growing up. Now, she grew up in the Eastern European country, in the Ukraine. That's where she spent her early years. And she used to tell me how terrible conditions were there. And she said it was so hard to work. She said we lived on a farm and we worked very hard, but we tried to make other money. And we often had to walk 5, 10, 15 miles in search of work. And very often we couldn't find any. And when we did find some work, it was very poor. And I can tell her countenance was kind of gloomy when she would tell us this. And then she would start to talk about coming to this country. And this is about 100 years ago now when she was coming to this country. And as she started to talk about it, her face would brighten up and her eyes would start to glisten. And she said, I couldn't believe what you have in this country. She said, I was able to get a job working during the day. I was able to get another job cleaning offices at night. And then I could get a job on weekends. And she was so excited. To her, this was heaven on earth. And I look back to what she was making at that time, and the equivalent today. She was probably making what a peasant in Mexico would be making today. But to her, this was success. She was rich. And that got me thinking, why is it that some countries really do so well and other countries do so poorly? And economists have answers for this, but as usual, there are different schools of economics and they have different answers. One answer, believe it or not, is, well, sometimes things just happen and that things really turn out well. You have innovations, people discover computers or they discover an iPhone, and all this innovation spills from one industry into another, and then you get a pickup in economic activity. And then people run out of ideas and everything seems to slow down. And that was not a satisfactory answer for me, because I said, hey, Why is it that this happens in some countries and it doesn't happen in others? Why does it happen more in some countries than it does in others? And so I looked around, and sure enough, there's another answer that economists give. They said the reason this occurs, the reason prosperity occurs and good times occur, is because certain countries have policies devoted to economic freedom. Now, who said this? Nothing. It was said by the two most famous economists that ever lived, Adam Smith and Milton Friedman. Adam Smith wrote this about 2.5 centuries ago. Milton Friedman, over half a century ago, reiterated pretty much the same thing. They said the key to prosperity is to make sure people have economic freedom. And the question is, what do you mean by economic freedom? By economic freedom, a very broad general definition, is that you put most of the economic decisions in the hands of individuals, businesses, and markets. It's a general, broad definition of economic freedom. Now, but what I wanted to do is I wanted to go through, not in the way Adam Smith did and Milton Friedman did. What they did is they used anecdotes. Milton Friedman would go to Taiwan or Hong Kong and say, look at how energetic these people are. It's because they have freedom here. They have low taxes. They have less government. They have no regulations. They have free trade and free markets. And then he'd go to Japan and say the same thing. And Adam Smith did the same thing. What I wanted to do is I wanted to go back and say, wait a minute. We should be able to be a little more specific about what's involved in economic freedom. And a long time, and I did this when I was here last time, I talked about freedom meaning the government is more moderate, doesn't spend as much, we have lower taxes, free markets, less regulation. But these, again, are too broad. So in order to test whether or not policies in this country were geared toward economic freedom, I developed some very specific criteria for my latest book, which I've just finished. It's not published yet, but it will be out. It's called Rich Nation, Poor Nation. What I said is, okay, characteristic of free markets or freedom in our economy would be when government spending, particularly for non-defense areas, is increasing slower than spending in the rest of the economy. So the government is shrinking relative to the rest of the economy. Where tax rates, particularly for investors and businesses and savers, are going down, or where all tax rates are going down. Where markets are free, or if there are a lot of barriers to free markets, where those barriers are being taken apart. Where regulation is minimal, or if we have a lot of regulations, where those regulations are being cut. So this was my criteria for policies that moving toward economic freedom. What's the alternative to these policies? The alternative is you put more economic decisions in the hands of government. Now, the more you do that, the more you're taking those economic decisions away from individuals. So you're taking away economic freedom. And you can call that either progressive economics, you can call it socialist economics, you can call it communist economics. But basically, it's a question of how much freedom you're going to take away and how much you're going to take away from. In our country, we really haven't gone to communism, but we have gone to both progressivism and socialism. And I'd say we're right here, right now. What's socialism? Socialism is where the government owns or controls key industries or businesses. And as you know, since you're in the same business I am, the government now controls the financial industry, especially the banks. So that's basically a system or a figure of socialism. So the question then became, if we're going away from economic freedom, what are the characteristics of such a period? And they are the exact opposite of the characteristics of moving toward economic freedom. That means government spending is rising faster than spending in the rest of the economy. Tax rates are increasing, especially on investors, high-income individuals, and businesses. Where government is increasing its control of markets, maybe by raising a minimum wage law or something like that, where there is more regulation being put into effect. So now I've got my criteria. And what I did after getting this criteria is I went back to 1900 in this country, not literally, figuratively, went back to 1900, looked at all the economic data that I could, and found out which policies were occurring in all the periods. And when I did that, I noticed I could identify 5 clear periods in our history since 1900 when our economic policies were moving in the direction of economic freedom because of the criteria I established. And I talk about what was going on in each of those periods in my book. And then I was able to identify 5 periods when we were moving away from economic freedom, according to my criteria. There were 52 years since 1900 when I've identified our policies moving away from economic freedom, and 50 years when we were moving in the direction of economic freedom. If you do the math, there are an extra 13 years involved. And those were periods, mainly World War II and the Korean War, War and Peace, where I felt that the wars were dominating policy. It really wasn't a clear indication of either a classical period, which I like to call it, or a progressive period. Now, having done that, I then looked at how the economy performed. And I looked at a lot of variables, and I put those all in the appendix, but the one that I really focused on was the average after-tax income of a particular worker. And what I found was that since 1900, this is the course of after-tax income for an average worker. After taxes, after Social Security payments, this is what they get to take home. And it turns out last year was $38,000. The pre-tax was something like $56,000. I like the after-tax because I think it gets us back closer to what a lower income or typical worker would be. That's in the just below the average. And the reason I believe that is because there are an awful lot of factors that go in up here that a person who has part-time work really would not enjoy. So I think this is more characteristic of what's happening to the middle or lower middle income individual. Then what I did is I said, okay, let me take some hypotheticals. What if we never went through any of these progressive periods? We just had classical periods. This was a classical period here up until 1913. What I did is I said, I'm not going to take the actual. I'm going to take, because policies changed dramatically in this period here, what I'm going to do is just assume the policies had not changed and take the average growth rate and then pick it up again during the next classical period. What would have happened, obviously hypothetical, to wages? And this is what we end up getting. The average wage today, with this hypothetical assumption, would have been $114,500 because of the effect of compounding that you're so familiar with. Then I did the exact opposite. I said, okay, this was a progressive period in here from 1913 to 1920. And then we went back to classical policies. Let me assume that we never went back to those classical policies. We'll just take the average of what happened during the progressive period and continue that on. And this is the end result. The average income today would have been $20,000. And the interesting thing is the entire increase in incomes from 1913 all occurred in that one period that I couldn't identify. It was the nebulous period. 87% of all our gains in wages occurred during the period when we had classical economic policies in effect. Now, this is hypothetical. We can't go back. We don't get do-overs with respect to the economy. However, what's hypothetical in this country, when you go around the rest of the world, is an actuality in the rest of the world. There are some countries, such as Singapore, that although they started a lot later than ours, their average wage is somewhere in the vicinity of $80,000. And then you have many of the other countries in the world that basically have never had policies of economic freedom, and their wages are terribly depressed. So basically, my conclusion here is that classical economic policies, policies that move in the direction of giving people more economic freedom, are really the key to prosperity. They're the most important thing. And when you move toward policies where you're going to tax investors, tax the rich, regulate the economy, try and regulate markets, you're going to have very sluggish economic performance, and you're not going to have increases in living standards. So that's the end of part one. Our economic freedom in the United States today, this is one measure by the Fraser Institute in Canada that measures economic freedom in just about every country in the world. Our economic freedom, we used to be one of the top 3 countries in the world. We are now number 16 down here with a significant drop in economic freedom. Let's move on to the second topic, monetary policy and the Federal Reserve. Money is so important. I know that sounds trivial and it sounds so obvious, but money is really essential to all business transactions. We produce about $18 trillion of goods and services in this country every year. We are one of the most productive countries in the world in this respect. $18 trillion. We need a sufficient amount of money in our economy in order to make all the business transactions that create this $18 trillion. What if we only had half the money we now have? Well, half of those business transactions would not be made. Even if an economy did everything it could to become productive and have the highest rating of economic freedom in the world, if you don't have a sufficient amount of money, you can't make those transactions. They simply aren't makeable. And what if, we're producing $18 trillion, and we've got the same structure, we've got regulations, we've got taxes, we've got everything else, but we're pretty much fully employed as we are today. And what if we had twice as much money in the economy? Well, we'd still produce the same amount of goods and services. We're not going to have any more workers just because we have twice as much money. Not going to have any more capacity. What are we going to have? We're going to have the same amount of output. We'll have twice as much spending, and all the rest of the increase will all come in higher prices. So we'll probably double our price level. So basically, money is essential to anything, which is why in 1913, the Federal Reserve was created. Congress created the Federal Reserve, gave it an awesome power to create money out of thin air. And there are only those 2 groups that I know of that can do that. One is the Federal Reserve, and the other is the counterfeiters. And we put counterfeiters in jail. And we take the head of the Federal Reserve and turn them into a folk hero in front of the TV cameras. Federal Reserve has an extreme amount of power to affect markets, as we've seen over the course of the past week, when financial markets and a lot of financial people were tied to their computers to try and find out what everyone knew, what most everyone knew they were going to do. They weren't going to change interest rate. It's important to understand just the basics of how the Federal Reserve creates money. What the Federal Reserve does is it buys securities. Now, you and I can buy securities too. We can buy bonds. But when we buy bonds, the money that we use to pay for the bonds comes as a result of the income we earned creating goods or services. In your case, it's services. You've created services for people, so you earned an income. And that's the income you've used to buy the bond. The Federal Reserve doesn't work that way. Federal Reserve writes a check, doesn't have any money in the bank at all. And you wouldn't do that. They write a check, they buy the securities, and then when the check comes through for payment, they simply tell the bank, you know what? You've got an amount of that check added to your deposit with us, your friendly banker, because the Federal Reserve is the banker's bank. What the Federal Reserve has done is it's put more money in the system. And another important technical thing that we should know is when the Fed is purchasing securities, usually it pushes the price of the securities in general up just a little bit, which lowers the interest rate, which is why interest rates tend to go down when the Fed purchases securities. If the Fed were taking money out of the system, they would do the opposite. What they would do is they would sell securities, depressing the price of the securities, raising the interest rate, and take money out of the economy, which is why when the Fed is talking about raising interest rates, a lot of people get really upset and excited because it may mean that money is coming out of the system. As I'll show you very quickly, that's not what it means this time around. Things have changed. It's very important to know about these changes. Now, the key question in monetary policy is, how do you get the right amount of money in? How do you know that we've got just the right amount of money that the economy needs to produce what it's capable of producing? And again, economists always have two answers, at least, to any question. One is, what you should do is focus on interest rates. If the economy needs money, you cut interest rates as much as you can, or maybe even to zero. But you basically manipulate the interest rate, you get interest rates down, and that's going to stimulate the economy. And if you think the economy is growing too fast and maybe inflationary, you raise interest rates. Other economists, myself included, believe that it makes more sense, if you're trying to figure out what the right amount of money is, to look directly at how many checks the Fed's writing, how many securities is it purchasing, or how many reserves as a result of these purchases are at banks, or how much is in the banks in terms of bank deposits and checking account deposits and other measures of money. So those are the two things. You may have already guessed, every individual at the Federal Reserve is a Keynesian. They all believe the interest rate is the key thing that is going to determine the right amount of money, and that they have the knowledge to tell you exactly what interest rate that is that's going to put the right amount of money in the economy. Now, they're all experts. Now, I'm not very impressed with experts. I haven't been for a long time. I tried to figure out why this is, and I did figure it out. It all happened in the fall of 1959. I was a senior in high school, and it was time for me to try and figure out what I'm going to do with my life. And so at school, there were signs all over, "Feel blue, see Mr. Gray." Mr. Gray was the guidance counselor. And I never understood the signs, because the name Mr. Gray just did not strike me as a jovial, optimistic type of fellow. But what is it? You know, I've got to do something with my future. Let me go in and just get some good advice from this college guidance advisor. So I went in, and immediately I saw that I was absolutely correct. This guy was not a very happy, jovial fellow. And not only was he a little unhappy, but when he opened up my record, he became even more unhappy. He took one look at it and said, "Young man, based on this record, it would be a waste of your time and your parents' money for you to go to college." He said, "Now, I see, however, that you have an aptitude that you really like the outdoors. So I would recommend you either join the Army or get a job digging ditches." I thanked him and left and decided not to take his advice. But what I did take away from that meeting, was an important life lesson. The experts don't always know what they're talking about. So I look at the Federal Reserve, and it's not just that they're experts that concerns me. It's their track record as experts. You might recall I mentioned that the Federal Reserve was created in 1913, and the main responsibility, the main reason for giving them all this awesome power to create money out of nothing was to prevent financial crises from occurring. They might make little mistakes, and there might not be just that much money needed to run the economy the most efficiently, but under no circumstances were they to ever allow for a financial crisis to occur. Well, 7 years after the Fed was created, we had our first financial crisis. A decade later, we had two major financial crises during the Depression. And 8 years ago, we had our most recent financial crisis. And it's worse than that. Not only did the Federal Reserve fail in its main mission to prevent financial crises, the Federal Reserve, according to many indications, contributed to each one of those financial crises. Let's look at the past 15 years or so and see what the Federal Reserve has done. What I did here is I put down on a chart the amount of securities that the Federal Reserve owns. Throughout their entire history, from 1913 to right now, they have purchased a little over, at the beginning of the century, they had purchased just over $500 billion of securities. That's all they own as a result of all their money-making processes from 1913 all the way up to the beginning of this century. Now, we had a recession. That's what this gray area is at the beginning of the, at the turn of the century here, at the beginning of 2000. And what they did is they started, as you might imagine, to aggressively purchase securities, get interest rates down, to get spending back up in order to generate a recovery. But what they did is they increased their purchases of securities at about a rate of 6 to 7% a year, which is a pretty high rate. By the middle of the decade in here, we had an economic boom. How many here recall the middle of the decade, maybe if you were in Florida with real estate agents, buy this house today, because within another year, it's going to be worth 10 to 20% more, bare minimum. That was the economic boom. Why? Because spending's going up 6 to 7% a year. We weren't capable of creating 6 to 7% more goods and services, so inflation came up. And what does the Federal Reserve do then? They slow down. In 2007, they purchased no securities. Now this, to me, was a tightening in monetary policy. Why? Because people are spending money. By this time, the economy is slowing, so it's maybe 5% or 6% more each year. But all of a sudden, there's no new money coming into the economy. That makes things tough. So the economy starts to slow down, and actually by the end of the year, the economy, we now know, turned down. You didn't necessarily know it at the time. And the Federal Reserve is warning all over, we think there's a lot of trouble ahead. Bernanke's saying we might be in for one of the worst downturns we've ever had. And what does the Fed do? Start selling securities. Now, I don't have time to go into the details. It's on my website if you want. I've got a 14-page paper as to all the details. But the bottom line is, this is QE 123 in reverse. They sold off $300 billion of their securities, 39% of their portfolio. Huge lack of liquidity in the economy. By September, Lehman Brothers fails, followed immediately by many other failures. The auto companies, all financial institutions, AIG, there's trouble all over the place. By this time, the Fed has gotten the rate down to zero, the Fed funds rate down to 0%. Nothing is going on in the economy. People still talk of a Lehman moment. You know, Britain votes to get out of the EU. It's a Lehman moment, run and sell everything. Why? Because a lot of people felt, well, because Lehman failed, everything else failed. If only Lehman hadn't failed, everything would have been fine. That's nonsense. This was a lack of money. People were selling assets left and right to raise money. Now, the Fed does practically nothing. This is given the fact of what happened here. They're doing next to nothing with respect to purchasing securities. And they can't figure out why, with zero interest rates, the economy is not responding. So in February, they finally decide, well, we've run out of options. We don't think we can go to negative interest rates, so let's start purchasing securities. So they start purchasing securities in February. March, the stock market, which had been collapsing with the economy, turns around, and we start the recovery in the stock market. 4 months later, the economy turns around. Now, am I saying the Federal Reserve was responsible for the financial crisis of 2008? Well, yes, that's exactly what I'm saying. So the question then is, what has happened since this financial crisis? And I have here, again, the purchases of securities as part of the Fed. Now remember, they had only purchased $500 billion in securities, basically from the beginning of their existence. Over the course of the next 8 years, they purchased almost an additional $4 trillion of securities in their portfolio. And you would have said, well, normally, you know, here it is. They have just put their foot on the gas pedal of money. They put the foot to the floor. Money is pouring into the system. And you would say, well, we didn't have this explosive rise in spending, which fortunately for my credibility, I did not predict we'd have, because at the same time, I don't know how to do this, they were pressing on the gas. They were also putting the other foot on the brake. They were making significant moves to restrict the money supply. What were those moves? They're raising bank capital requirements. The regulators are going into banks telling them you can't loan to this, you can't loan to that. And the banks are saying, but these are good people, we know them. No, you can't loan to them. And if you're a bank, you listen to the regulator. So they were taking restrictive action for the banks to build up their capital. One way in which the banks built up their capital was to simply take a lot of this money that the Fed was, or reserves that the Fed was putting in the system, and simply leaving it with the Federal Reserve instead of loaning and investing it. And this is how much of this was done. Now, to bring us up to date, almost 2 years ago, the Fed got worried and said, you know, we have no idea what we've done here. But we think maybe there's something here that's a little scary. So we're just not going to buy and sell securities anymore. That doesn't mean we won't play with the interest rates, but we're not going to buy and sell securities anymore. Now, normally this would mean, oh, tight money. There's no money coming into the economy from the Fed. However, all these funds that the banks had built up, putting at the Fed, the banks have now taken them down. And that's about $500 billion that they have put into the economy over the course of the past 2 years when the Fed hasn't been creating any money. So we've been getting money in the system. It's been coming in as a result of the banks shifting their deposits at the Fed back into loans and investments. So it's the banks that are pretty much running whether or not we have more or less money coming into the economy right now. And I think we have enough money coming into the economy. I think the economy has other problems as to why it isn't expanding more rapidly. What the Fed is doing is it's playing with interest rates. Here's the Fed funds rate, which is close to zero until the recent increase and maybe another increase at the end of the year. But you might ask, if the Fed is not selling securities, which is normally the way you get up interest rates, how are they raising interest rates, and how do they plan to raise it in the future? That's a very good question. I'm glad you asked that question. It's the way the Fed has been doing it all along. What the Fed has been doing is focusing strictly on interest rates like someone in Russia would have fixed a price of a particular commodity. What they have been doing is they've been selling securities with an agreement, that, and a lot of them, and with an agreement they'll buy them back the very next day at a price that is equal to wherever they want the interest rate to be. So they're not putting it anymore or taking it out other than overnight, but they're doing it specifically to play with interest rates. Now, this line up here is my estimate of where market interest rates would be if the Federal Reserve were not playing this particular game. And if you play games like this and you keep rates away from the market for an extended period of time, you build up pressures. I had another chart that I used, depending upon the presentation, of oil prices. And my fundamental price of oil for the past decade has been about $50 a barrel. Now, the actual price had gone up to $100 a barrel, even more than that at times. And what I would tell people is, this is the market, or the equilibrium price. This is why you're going away from the market. And the more you build up pressures like this, the more on one point you are going to move very dramatically in the direction toward markets, and you'll probably overshoot that market depending upon the length of time you're out of whack. I believe that that is the potential that the Fed has built in here. I don't expect it soon, but it's a concern I have that at any point we could have a very significant, sharp upward move in rates, because no one, including the Fed or including me, knows exactly what the implications are of the way the Fed has changed this policy. So to me, this is a very important point. It has implications for the holdings of bonds in your portfolios and your clients' portfolios. Let's go on to the last one. I've now looked at economic growth, prosperity, monetary policy. It's time to look at the election's impact on the economy and financial markets. And I want to start with Hillary Clinton. It's very clear Hillary Clinton is very proud to be a progressive. When I look at her economic policies, increasing government spending, higher taxes for the rich and business, increase in regulation, she wants to increase Dodd-Frank. She said it just has not had enough regulatory effect, and she wants to increase it. Controls over markets, the minimum wage is only one of them, education, health, utilities. Judges who will expand the government. When you go back in history, every one of those progressive periods identified, the exact same economic policies are there. So this is not new. This is exactly what happened during each one of those progressive periods. What are the impact of her policies likely to be? The same as the impact that we've seen over the past 10, 12 years and every other progressive period that we've seen. Flat to lower living standards, slow growth. Now, if we have slow growth, what's going to happen to interest rates? They're going to stay low indefinitely. I mean, the Fed will just not, they might not even raise them at year end if the economy continues to look weak. So we may go another year with interest rates exactly where they are right now. From the Fed standpoint, this is stimulus. And if they raise rates, they're going to be restraining the economy, even though they're not taking any money out. That's the way they think of things. So if they think of things that way, they're going to keep interest rates low in this environment for an extended period of time. However, the longer that lasts without growth, the more there will be pressures for the Fed to do something. We're not going to see a change in policy because if the people have voted for progressive economic policies, we're probably going to have progressive economic policies. You can't avoid that. And then you're not going to have any growth. So they're going to look to the Fed as a way, they're going to say it's because we don't have enough money. It can't be our policies that are holding things back. So they're going to pressure for more money. And eventually, I assume, they're going to succeed. One way or another, they're going to get more money into the economy. And when that happens, you get higher inflation. And when higher inflation happens, that's when the interest rates can just skyrocket. And you don't even have to wait for the inflation. People are smart enough to know if spending picks up to a certain pace, inflation is going to follow in this type of environment. Let's turn to Trump's program. For the most part, his program is a move consistent with the sort of classical policies we've had in the past. He wants less government spending except for defense. And that's exactly the same thing that Reagan had in the 1980s. Exactly the same policy. He wants lower taxes for everyone, rich and poor. So at least you're going to get the cuts for investors and savers, so there'll be an incentive to save again. Want fewer regulations. To me, this is one of the biggest parts. On my website, I've got a paper I did on the cost of Dodd-Frank, which I had estimated at $200 billion a year. And I went through very deliberately explaining where that was coming from. And you can see that on my website. Eliminate that, and you eliminate $200 billion of waste in the banking system. A year. I mean, this is big money, and that's only one of the regulations. He wants to remove the restrictions on free markets in the health industry and other industry, and I think he's absolutely right in this case as I look at economics, except for his tariffs. Now, here's where he gets into trouble, from my perspective. The idea of placing tariffs on the economy is an idea away from economic freedom. What you are telling people is you can't voluntarily buy something that's produced in another country. And his explanation that because of our trade deficit, that these countries are stealing from us is simply way off base. They're not stealing. These are voluntary transactions that people are making. This idea that they're manipulating the currency, they're not manipulating the currency. They can't manipulate. We are manipulating our currency with our low interest rates as much as they are manipulating their currency. So I believe he's way off base on that. And there are risks, and he will appoint judges who will limit government. Now, how do I assess both of these? Well, what is the main risk of Hillary getting elected president? Main risk, from my perspective, is that she succeeds in doing what she says she wants to do. That would hurt the economy. what is the main risk from an economic perspective of getting Donald Trump elected president? And the main risk is that he focuses on tariffs and on trade restrictions and on creating all sorts of problems with other countries. From my perspective, I believe Trump may be smart enough to realize that once you've done these three things, we no longer have the problem of other people and our businesses going to other countries, jobs going abroad. I mean, our country will boom to such an extent that we really haven't seen before. When I look at the history of economics, what I've seen is we've gone through some very bad times in the past where we just struggled with no increase in living standards. But once policies are changed, we can make up for a lot of what we've lost in the previous periods. And the models don't capture this. I think Trump's instincts are better than his economic advisors. He said we can grow at 4% or 5% a year if you do all this. And I think that's conceivable from my knowledge of history. His advisors have talked him down to taking it for 3.5%, which is fine. Any growth is good. Plus, I think it's a mistake to overpromise on what you can achieve. And these things take time, so you're not going to see it immediately. So I think it's good to be cautious. But the main risk for Trump is that instead of focusing on the policies with taxes and spending and regulations, he turns to his trade policies, which I believe are a move away from economic freedom. And if he were to turn to those first instead of the others, then I think the economy could be in trouble. Let me quickly summarize so we can have time for questions. The first thing I talked about was you might be interested in stock prices. I don't know. Anyone interested in stock prices? It's going to take the time away from the questions. But the impact of policy. Yeah, higher living standards, faster growth. What happens to interest rates? They go up sooner. Why? Because the economy is going to get going. Now, how soon is it going to get going? The policies have to be put in effect. They have to pass the tax policies, the spending policy, the deregulation. If that can be done by next summer, I believe the latter part of next year, we would see upward pressure on interest rates. And now the Fed, so long as there are signs that the economy is picking up, the Fed's going to go along with it. They're going to raise the interest rates. So we would look for that. And the bond rates would go up too. And remember, you always have that potential for the bond rates to go up very rapidly relative to these other things. Less pressure to increase the money supply. If the economy is growing, there's no pressure on the Fed. I often said, if I ever got to be Fed chairman, I wouldn't want to do it in a progressive environment because it's a losing proposition. I'd want to do it with classical policies because there's barely no pressure and you'd be able to sleep at night a lot better than you would otherwise be able to sleep. So longer term, this is out a couple of years, I would see lower inflation, lower interest rates. And yeah, almost forgot, the stock market. There are three things that really dictate the value of the stock market. One is, and the most important, earnings and the earnings trend. The second is the level of interest rates. And the third is the psychology in the market. What this is it's a chart from 1946, the end of World War II, right up to the present, on the earnings for the S&P 500 companies. And that middle line there is a growth rate of 6.5% per year. And what you can see is through good times and bad, the S&P 500 was able to increase 6.5% per year. This even occurred during the worst progressive periods that we've had. There's a lot of pressure. Why is that? Well, when the government puts a lot of restrictions, regulations on the banks or other companies because of these progressive ideas that are so great, what happens? You waste a lot of money in the economy, but the companies react. What they do is they absorb the regulatory costs and then they pass them on to the worker. And so it's the worker, the common guy who's working or gal who's working, who end up taking the hit for the economy. That's why I use the after-tax wages. So the economy can even look strong in many cases, but basically people's living standards are not increasing. The companies have been able to adjust their situation to make sure they continue to make earnings. And incidentally, it is this earnings trend that I use in trying to estimate what the value of the stock market is. And this is my estimate of the fundamental value of the S&P 500. This is the latest figure. My analysis says that the S&P 500 is 20% below its real fundamental market value today. But look at this. It's been a lot worse. It's been way, way worse. Why? Well, the reason is, look at the history of the stock market from the beginning, from the turn of the century. I mean, people have lost a ton of money in the market, and they're scared, and rightfully so. Now, they're getting less scared the longer this sort of situation exists. But there's still a big fear in the market of losing your money. And so there's a strong psychological element in the stock market. I believe next year, this gap is so wide that unless the economy is a disaster, you're going to continue to see this upward move, regardless of who happens to be elected president. But that's my stock market move. Going out into the future, I believe if we do have a continuation of negative policies, we will eventually, and interest rates do spike upward, the fundamental value of stocks will level off and start to come down. But again, you've got such a wide thing. As a matter of fact, I think under a Trump presidency, if he does all the right things, we could still have this because the interest rates would go up. But I think this gap would close much sooner. And my guess is you will become significantly overvalued, setting the stage for a market decline sometime after that. Quick summary. Let me do away with the summary and use the time for questions and answers because I'd really like to get that in. Stop there. Do any of you have any questions regarding what I said? Yeah.
What would
Rob?
be a healthy interest rate increase, in your opinion?
Healthy interest rate? The sooner we can get back to a market rate, the better it is. The problem with the artificially low interest rates is that they encourage debt and they discourage savings. And most important is you discourage savings. Without savings, you don't have the funds for investing in the future, which are one of the elements of a growing economy. So the Fed has really done a bad job. So I like to see them get up as quickly as possible. I do not like to see shocks to the system, especially when everyone's mindset is that when you raise interest rates, you're taking money out of the system. So if I were at the Fed, I'd try and explain that first. Hey, we're not taking money out of the system. If we were, I'd be scared of, a liquidity crunch and all those other things. But you can't change people's minds that quickly. So I think it makes sense to measure the increase, but also to tell people and explain to people what you're doing. I think the Fed has not explained any of this. I don't think they understand this, frankly. Again, it's my skepticism about experts. I just don't accept what they say. I don't know if they've got a hidden agenda and they really know what they're doing and they just don't think they can tell everyone, or do they just not know what they're doing? When people don't explain it, I always assume they don't know what they're doing. They may be right or wrong. Another question.
That kind of answers the question I was going to ask. The conspiracy theory, you know what I mean? The whole Fed conspiracy thing. Making that big mess in 2008.
No, they're not smart enough to do that. I don't think. If you read my paper, you'll see the mistake that was made was the exact same mistake that was made in 1937 in the same way. The damn economists. It was, in both cases, an economist came before the Open Market Committee and explained why they should change their procedures and do things differently than they had done in the past. And they all agreed with them. And once they made a decision, they never, ever looked back. The parallels are fascinating, but it takes a long time to discuss that. We don't have the time here. Yes?
What about the interest rates worldwide that are so low? And then if we raise ours, wouldn't that cause imbalances that they wouldn't be able to control?
Well, we'd have probably, as a matter of fact, it happens every time it looks like we're stronger than other countries. Funds come in and the value of the dollar tends to go up. Because,
Causes a drain on.
It makes their situation worse. Now, why are all the countries going in the same direction? Why have they all been sluggish in the developed world because of monetary policy? Because this increase in capital requirements that I talked about of the banks that has constrained their ability, that's worldwide. That was the Basel Accords that occurred. The European bankers got together with the Fed. You know, all these meetings that they have, where all the attention is, oh, what are they going to do? They all got together and decided, since the banks caused the last financial crisis, banks must need more capital. They don't have enough.
Right.
Now, that was right for before the financial crisis. They left the banks not have enough capital. Now, the banks might have had enough capital if the Fed didn't screw it all up by taking all the money out of the system. But when you have an economic boom, that's the time you raise capital requirements. You don't raise capital requirements after the crash when the banks are going bankrupt. I mean, it doesn't make any sense. And I'd like someone to explain. You're going to raise capital requirements of all the banks worldwide?
You're going to make business harder to do.
Yeah. And to me, it doesn't make any sense. And the fact that you now all of a sudden are having trouble getting...
Hey, Chris, I don't mean to cut you off, but
Yeah.
none of that has to do with my question.
Oh, I'm sorry. I'm like a politician. I don't care what your question is. I'm gonna answer what I think it
That's all right.
Okay, but oh, you have a question.
I was like, well, is it like what happened like this last turn where they didn't raise interest rates? Has a lot to do with the fact like the British just, after Brexit, cut their interest rates. So if you cut this interest rate over here and we raise ours, then, obviously there's a trade between the countries. And that's one of the big things with Brexit. So they're worried that they're going to be able to, they have the balance between the continent and England, right? So my question is if everybody else is cutting their interest rate, we raise ours, the money's come back, all the dollar goes up, then our exports are less attractive, slowing down business in the United States. So if you raise the interest rates and get too out of whack, you're counter to raising the interest rates, so then you just have to cut them and go back.
That's a great point, yeah. But is there a question? But is there a question? That's why I don't answer the question. There is no question.
I know you guys are all thinking this is funny. Stop. My question is, you were going off on some other tangent.
And so are you. I'm
Talking
sorry.
about raising interest rates to possibly 3% in a very quickly period of time. But isn't this the trade causing it not to do that?
It might be. I mean, I have no idea how they think about interest rates, because they think they're stimulative when it's low. And that's the mindset of just about everyone. So whether they're also thinking about changing the value of the dollar and the competitive nature that we would have, I don't know. And that's probably an inconsistency, because there are so many things that happen here with what Trump says. Trump says that they've manipulated their currency. So obviously he doesn't want our currency to go up. But guess what? If he implements all these policies and our economy soars, not only will our interest rates go up, the value of our currency will go up, because people are going to want to come here and invest. And what's he going to say? Now you've really messed it up. But your point is a great one, because there are all these countervailing things that are occurring. My judgment is, no, you tell the world, listen, you guys have screwed up. You've got progressive economic policies. We're going to classical policies. Whatever happens here, we're going to have our growth. When you catch on and when you see what happens here, you can adopt them, because you should. But we'll show you what to do, and not worry about anyone else. Okay, I'm sorry. Any other statements or questions?
I didn't see on that, the first or second slide where you were showing the wages over time. Was that adjusted for inflation?
Yes.
Yeah, okay.
Yeah. And it's on a log chart, so you can see percentage changes are the same. It doesn't, dive up like that. Yes?
On that same slide, did you put into account the average amount of hours worked?
Yes.
Okay. Is that on your website too?
Pardon?
On that slide, I just didn't see that.
Oh, it might have been in the footnote below. But when I did the research for my book, the figures are taken from the U.S. Census, and they're very good figures from they're based on tax returns for individuals. That's how we can get, and I do show it, total compensation per, it's a full-time equivalent employee, so which takes into account your hours thing. So I've got compensation per full-time equivalent, which incidentally is a lot different than after-tax wages, because the companies, as you well know, per person are just paying a ton of money for each person. The money is being laid out by the companies. It's after you've allowed for the benefits, and then after you take away the taxes, and the benefits include the Social Security, that you start getting down to what the worker takes home. And I explain why I believe that that is a more meaningful figure to look at than a lot of other figures. Yes?
You continue to mention your website. What is it?
Oh, the website is classicalprinciples.com.
Okay, and when will your book be available?
That's what I'd like to know. Frankly, I don't know the answer. What I've done is I've basically got it printed up, at Kinko's, it's done. And all the color charts are in there, and I've sent it out for like a peer review to the experts, the people. I've used a lot of the economic freedom. When I go around to countries in the rest of the world, I use the measures of economic freedom that were produced by these agencies that measure freedom all over the world. And that's my main source. I couldn't go into the policies, because I don't know the policies as well as I know them in the US, to explain exactly what was happening during each of these periods. So I use the freedom as a proxy for those policies. And I've sent the book to the people who produce those measures, because I want feedback, hey, is this the way you think it should be done? Should it be done differently? I'd like to get that out before the book is published. So it goes through that process first. But thanks, great question. I wish I knew the answer.
The paper that you spoke of on your website, where would we find that on the website?
Well, that's another really good question. I'm in the process of switching over from one website to another. I was criticized on my old website that no one really likes it. And it doesn't make me look good, so I said, okay. So I've got a new one coming up, and it should switch over at any time. If it's the old website, I think it's right on the first page toward the bottom. It was reprinted in Investor's Business Daily, so I think you got the reprint, and it explains the details of how I don't remember, something, and how Dodd-Frank is wrecking the economy or something to that effect. I think the $200 billion cost tab of Dodd-Frank. I don't know that. Any other questions? Oh, great. Hey, thanks a lot. It's always great to have you.